Hello and welcome to BloombergQuint. Both the global and the local spread of coronavirus is widening, leaving many of us wondering what's going to happen, of course, to citizens. This is first a humanitarian problem, but beyond that, what happens to consumers, what happens to businesses, what happens to investors? Lots of uncertainty out there. We're hoping to get some thoughts on how to map this entire spread and its impact. Joining us right now is Neelkanth Mishra of Credit Suisse. Neelkanth, thanks so much for taking the time to speak to us. Appreciate it. Neelkanth, I'm going to start with asking you what you're hearing from the ground up. You've always been someone who's had a very close ear to the ground. So I first want to ask you what's happening on the ground in India, because I think we are now not just worrying about the global fallout of this on the Indian economy and Indian businesses, but increasingly the local spread and its impact.
Right. So we'll come to the local economic impact because we are still seeing an early stage. We are in very early stages of assessing that, because what the governments across the world are trying to do, are trying to calibrate, is balance out the risk of the loss of lives with the potential cost of a near economic disruption. So when you shut down economic activities, of course, you take away a lot of people's incomes, but the hope is that you manage to ward off losses of lives. And given that no one really has any answers, this is not a very easy problem to solve. So most governments are taking a calibrated approach in the sense that they try something. If it doesn't work, then ratchet it up. If it doesn't work, ratchet it up further. And that's how we have seen the European and the American governments act. You saw California went into lockdown a few hours back. So the economic cost of this will only be, it will be possible to estimate the economic cost once we know at what level of near-term economic damage we are able to control the spread of the virus. So the changes made in Maharashtra today are also a sign that the government in India, I think, and governments, I would say state and central governments, are trying to, again, calibrate the response, how to minimize damage to livelihoods and still be able to fight the virus. We don't know if the current level of clampdown, where we've stopped international travel, we have stopped all non-essential services, is that going to be enough?
Okay.
And if it is, then it will be possible to estimate the damage. But the first estimates that are coming out, so you may have seen in China, for example, for a long time, people were uncertain as to how to even estimate what full year GDP should be. But the day the February output data came out, then suddenly what was 6% GDP growth at the beginning of the year became 3.3% or 2.9%, or depends on whose estimate you take. In the US, already growth rates are at -1%, -1.5% for the full year. That will definitely have an impact on India. And we are in very early stages of deciphering that. So one last comment on what's starting to happen. So reverse migration has started. So the business for taxi services is down 35 to 50%, depending on who you ask and which city you are in. What used to happen in April, when the Rabi harvest generally happens, and a lot of the migrant workers who drive taxis go back to their villages, that process seems to have started right now. Some of it is also evasive action, because most people live in very crowded surroundings, especially in the denser cities, and they may find it safer to be in the villages. The risk is, of course, that some of them can carry the virus to the village as well. But at this stage, I would say that the extent of damage is early to assess, but is already quite meaningful. I mean, there is already if you see company commentary, there are already problems of payments, and all the things that we are seeing on the dollar payment side, and maybe we can address that in some of the later questions you have, are starting to appear in the Indian financial system as well.
Okay, let me actually get into that global part and then I'll come back to local in a minute. Okay, one thing that's very clear is that both to the extent that the economy is exposed to the global economy from the export side and businesses that are exposed to global demand will perhaps be will be the first sort of line to get hurt in this.
Absolutely, but the first and so the fastest thing to move is capital, right? Because you can make buy-sell decisions at the click of a button, and financial markets move on Excel sheets, right? So it is much faster. So they're the first to respond, and therefore the first sign of stress. So even before you start to see a lot of order cancellation. So the obvious ones are, of course, that the airlines, the airports, the hotels, the cancelled conferences. So all of those, and the lack of tourists. Those are the obvious ones, but I think the strongest impact so far has been in the financial markets, where this shortage of dollars. So what happens is that when supply chains stall, so for example, I'm sitting at home, work from home, and I'm going to be working from home the next week as well. The normal expenditures I would have done are no longer happening, and therefore that cash is with me. The people I would have purchased those services from are not getting that cash. So there's an income problem. There's also a money velocity problem, and that slows down activity levels and loss of income. Now, within economies, and we need to address that, and I'll come to that when we talk about India. But at a global level, if you're thinking of global trade, that drives because global trade is only in dollars. Suddenly the velocity of dollars drops. And when uncertainty picks up on what's going to happen to earnings, what's going to happen to creditworthiness, and suddenly the demand for dollars goes up. So some of the responses that you saw from the Fed, which a lot of people thought were a bit premature, was most likely a response to the dollar funding problem. We have seen money flow out of emerging market funds, both debt and equity, at a pace which is significantly higher than what we saw in 2009. In terms of quantum, those numbers are already higher than in 2009, and they've happened in like half the time or maybe less. So that's been the first sign of stress, and that is already starting to show up in our financial system. So in the sense that in the last 12 months, it's very hard to get aggregate incremental credit numbers in India, but there was $3.8 trillion or 3.8 trillion rupees, about 380,000 crores. That was the trailing 12-month borrowing in ECBs, external commercial borrowings. If you recall, in November 2018, the RBI had eased ECB norms by reducing the amount that you need to hedge, bringing down the duration above which you needed to hedge, below which you needed to hedge. And because of that, there was a surge. It was good because in the last 12 months, the amount borrowed externally was almost the same as the amount issued by banks. And NBFCs, have been slowing down sharply or shrinking their balance sheets. Now, because of the dollar shortages, suddenly there is a shortage of credit. And in these times, when there is significant uncertainty, even the short-term credit, so there is about $107 billion of short-term credit as of September 2019. I mean, we don't have updated data after that. But $103 billion is trade credit. Now, if the trade credit has to be rolled over and there's no dollars available, there are no dollars available, then those firms will have to necessarily tap into the domestic financial system. And for a variety of reasons, I mean, in addition to the fact that there's been an impairment on the NBFCs, but also because of some of the fears that have emerged after the moratorium on Yes Bank, the smaller private banks have also become a bit more cautious with holding on to cash. So growth has kind of taken the back seat. And this is a very worrying environment from a growth perspective. So the first part of your question, the most important linkage is the financial linkage. That we are already seeing that, right? And as the RBI has intervened in the currency market directly or indirectly, because there's been such a strong outflow from emerging market funds, so India has also seen outflows. investors seem to be selling stocks that they can, not what they should. And that dollar outflow is also creating problems and disruptions in the financial system. So that's the first sign, very obvious sign. But of course, there are other signs like, steel demand seems to have vanished because everyone expects steel prices to fall. So there is a buyer strike. But I think it'll be in the next couple of weeks that we will get to understand the true nature and the scale of the economic problems that we are facing.
Neelkanth, so there have been efforts both at the global central bank side. The Fed has, provided swap lines to some central banks, not to the Reserve Bank of India. The RBI has done some small $4 billion in the current context, doesn't look large in terms of, swaps where they're selling dollars into the market. But those don't actually tackle the problem that you're speaking of right now, because the question is, where will some of these borrowers who are relying on overseas credit then fall back upon?
Correct. So, so those channels need to be opened up. See, and let's be honest. Let's be fair to the central bankers also. I mean, this is not something that a lot of people have experience with, right? So it's like a patient coming into an emergency room, and you have to figure it in runtime what's happening and act, right? So you can't really wait too long. So you try a medicine, doesn't work. You try a different medicine, let's see if it works. Sometimes you increase the dose and figure out if it works. So that trial and error is going on. And whether it should be trial and error, and if there is a rule book which can be followed, I don't think there is one. But I think people will have to take decisions, basically shoot from the hip. And so that's what is happening. For example, swap lines, right? If there is, so yesterday some swap lines, the Fed opened up to some of the emerging markets as well, Brazil and Mexico, because they figured out that the dollar shortages were actually quite extreme outside of the US. And so those swap lines had to be managed. What had started to happen because of some problems in the debt mutual funds was that they had to then, the CP market in the US had frozen, so they had to come in and do CPs. And like in India, the central bank cannot take credit risk, so the Fed had to backstop it. And so they had to put in some money saying that we are giving a credit guarantee, and so you go ahead and buy all corporate CPs that you can. The problems in liquidity in the domestic bond mutual funds, where 2-year CD rates for banks have shot up, and there is a clear very tightness of liquidity in the secondary market. Bond yields have shot up. So this speaks of, so again the central bank I think will need to respond, and they may respond in their own way. There are various suggestions that are being made to them, but so the thing is that there is no rule book for something that happens so suddenly, and I think central banks and regulators and governments will have to solve the problem as we go.
I understand that, this is an unprecedented situation, Neelkanth, but to your mind, so I think there are two approaches, right? So far, they have said, okay, we will tackle the system. We will provide both dollar liquidity to the system, rupee liquidity to the system. But given the fragilities across the chain, would it be preferable to move into more targeted interventions? It could be via refinancing lines, direct liquidity lines to certain sectors, or MFs, etc., which has been tried once or twice in the past. Would we very quickly have to move to the latter, because just supplying the system doesn't seem to be enough right now?
So response has to be calibrated, right? So just like we saw, so see, there is a lot of moral hazard in a lot of what we are doing, and the moral hazard reduces, not reduces, its importance reduces the more severe the problem is, and so that calibration, I think every central bank has to do. So the Fed first did all that it could in terms of saying we'll buy so much of treasuries, we will open up, almost unlimited refinancing. And then they found that, look, the problem was not, it's not just in terms of just dollar availability for US borrowers, it is also in the CP market. So then they did something on the CP side, but that's actually taking credit risk, and therefore the treasury had to come in. And so I think, and that is why it's important that there be a war room kind of a position situation where decisions are taken very fast, because solutions will have to be found on the fly. Should there be more directed intervention? Directed interventions, I think, in the heat of the moment are understandable that we want to go for them. But if you're a policymaker, you have to be very clear about what legacy you are leaving behind, and what precedents you are. So forget legacy is actually much longer, but say what precedents you are leaving behind, because in the next cycle, then the market will expect you to do all of those things. So, like, one of the countries shut down their stock market, and when it opened, then the market was down like 20% plus. So it is very tempting to do some of these things, but you need to be cautious about. So when you are trying to be directed, you are applying discretion, and the extent to which you can apply that discretion is decided by the extent of the problem. In the sense that, suppose the U.S. government goes ahead and there's a $50 billion demand from the airline industry, and airline industry is really badly affected, right? They have very high financial leverage, very high operating leverage, and the fuel prices are down. I think there's no one flying. Now, is it really the government's responsibility to bail out airlines? Should they not just go bankrupt, be bought out by other airlines, and is it in the public good? Now, there are answers. I mean, while it's obvious that airlines need to be, it seems obvious to us that airlines need to be bailed out because it's an essential service. You do not want new firms to be emerging, and you cannot have new firms emerging out of nowhere and setting up this kind of large infrastructure. And you want to keep these businesses going, but there is moral hazard. So I think it is going to be an evolving situation, and I would expect directed or rather targeted intervention only when things go really out of hand.
There is, of course, a clamor for lower interest rates, and not in a negative connotation. I think, given just the economic impact, which will be disinflationary, certainly, there is a justifiable need for lower rates, which will probably come in April. That is one part of the toolkit.
See, that is for the MPC and the RBI to decide. We can only prescribe. See, from a prescriptive perspective, I mean, I have been talking about it for 2 years, even before we saw the growth decline and the fact that oil prices are plumbing new lows, and if oil prices fall, a whole range of things fall, right? So aluminium is nothing but packaged energy. So aluminum prices fall, you have palm oil prices falling, biodiesel prices fall, so food, corn, ethanol, so food prices start falling. So there's a lot of linkage to crude oil. If oil is where it is, then clearly core and headline even in India should be expected to come on. And given the extent of the economic damage that is potential, of course, very hard to estimate at this stage accurately, but clearly it will be significant. You want to front load it because you do not want, even at the margin, someone who wants to borrow getting discouraged by high prevailing interest rates. So if nominal GDP growth at 8% and effective borrowing rates at 10-11% was a problem, if your nominal GDP growth is even substantially below 8%, then 10-11% doesn't make sense, right? Even less sense. And therefore rates have to be brought down. And I think it may not just be the repo rate cut, which is at this stage mostly become a signaling mechanism, which is what it has turned out to be even in the developed world. But it'll have to be a lot more of open market operations, because it's clear that there is going to be a fiscal stimulus. It is clear that there needs to be a fiscal stimulus. And you don't want the bond market to start fretting about who's going to buy those bonds. So the central bank has to come in, and at this stage, it seems to be all hands on deck. So as that happens, you need to bring down 10-year bond yields. You need to reduce the credit spreads. For that, there needs to be swap lines, perhaps, or other, so refinancing lines that are available to mutual funds. There may need to be counter-cyclical interventions by the funds that the government has some discretion on. So all kinds of attempts must be made to bring down the effective borrowing rates. I think just cutting repo rates may not suffice.
Which moves me to the bigger issue, Neelkanth, right now is, how do you protect to the best extent possible incomes in businesses which before this were viable businesses? So the liquidity risk turning into the solvency risk kind of principle. That is the immediate problem, isn't it? And I mean, without wanting to be prescriptive, the only sort of available tools in public discussion forums are things like cash transfers, etc. Would we need to go in that direction? Should we at least start considering that, to your mind?
Yeah, I mean, see, as you may have imagined, people are. I mean, the last time someone saw this, and therefore, people are going back to books written for the Second World War. I mean, how to finance a war, etc. Because this is a very large economic disruption. Whether India gets as badly impacted or not, time will tell. Hopefully, we're acting early enough, and we'll be able to control the spread of infection and going out of control. But in terms of economic impact, I think this is quite significant. It is also, I think, even from the perspective of managing a lockdown. See, it is possible for you and I to work from home. But for most people, it is not possible to work from home. I mean, in India, where there is a very large informal population, even if you ignore the rural population, which of course has a very different work schedule. I mean, there are no weekends and very different patterns of work. But even in the cities, people have to travel by train. People have to. There are so many daily wagers. And it is very important that, and then they have barely any buffers. So I think because of the strong society we have, and we may have a weak state because the governments are too small, but we have a strong society. So there are social norms, social buffers. Hopefully no one will go hungry, but if it is only for, say, 2 weeks or 4 weeks, there's enough informal credit that goes around. But it is going to be very hard to convince some.
All right, I think we've lost Neelkanth there. We will try and reconnect to him. I'm just going to try and summarize in the meantime what he was talking about. I think, it's very tough to unpack this situation, but we were trying to unpack it into the impact coming from overseas, which is both through the export channel, but as he was clearly and very importantly flagging off, it first comes through the capital market channels. We've been seeing that. And I don't just mean Sensex Nifty, it also, as Neelkanth was pointing out, comes through via dollar shortages. And then, of course, we had just started talking about the local impact. He's back with us now. Sorry, Neelkanth, we lost you there for a minute. But I think the question, you were midway trying to explain to us as to how one starts to attack this income problem that will quite quickly emerge.
Correct. So even to, in fact, ensure a lockdown, you need to make it, possible for some. So some people who are on salaries, taking a week off, or the firm will take care of the cost. But for most people who are daily wagers, contractors, it is going to be very hard. And, and there are people, you must have read the stories about people who are refusing to stay at home despite being at risk of infecting others just because they can't avoid partying. I mean, imagine someone whose kids are not getting milk, so for them, there's no option but to go out and work. And to even ensure the lockdown, you need to make sure that they have certain incomes. So there is no other way that I can think of where you can make sure that they stay, their consumption, their basic income, and their basic behavior stays unchanged. That we don't see, for example, MG Narega is a great system to have at this point. Is a great scheme to have at this point, where you. It's a demand-based scheme, so people who need work can come and demand work, and the government, if it decides to, can reduce the labor versus materials ratio, and that can drive a significant increase in the number of.
All right, I think we've lost that connection again. We will try and get him back. All right, Neelkanth, I'm sorry, we're having connectivity issues, which is a whole different problem in a whole different industry. But look, let me ask you a targeted question. I think, there is one view out there that let's use the existing machineries. You were talking about Narega, so that is certainly one existing machinery. The other existing machinery is the JAM Trinity, as it had come to be known. Is there a way to quickly map those accounts, do some data analysis, and find a way to transfer money to curtail exactly the problem you're saying, that daily wages should not have to go out if there is a health risk?
Exactly. So I think it should be. I don't think targeting can be perfect, right? I mean, and the point is we need to act on this within days, not 2 months later. And so there will be a targeting problem. You can do a broad filter. I mean, of course, I don't have the data, but I'm sure the government and the RBI do, on the number of Jan Dhan accounts, the maximum balances, the kind of things that they've been used for, how many times they've been transacted. So you can have defunct Jan Dhan accounts, which I think were misused during demonetization by a lot of bank branch managers. So you don't want, and there are branch managers who may have created those accounts which they misuse. So there will be, I think, leakages. At this stage, perhaps one has to pinch one's nose and live with those leakages, given that the urgency with which cash needs to be transferred is much greater than the ability to fine-tune. But using some of those screens, it should be possible. Or, for example, if you look at permit holders like auto drivers, taxi drivers, the ride-sharing services, all of those, it's, I think, very possible, very easy to give directed transfers to. And it may not be possible to do that to a small tea vendor who was standing near a.
Okay, having a bad day. I think there are, so, if I were to just sort of take that thread a little bit forward, you need to try and protect incomes to the extent that is possible. We've already seen some companies announce job losses, and that's in the formal sector. So we were discussing the informal sector. Neelkanth, you're back. I'm really sorry for the continued interruption.
Sorry about this. My mistake completely. So coming back to the point and quickly finishing it, I think it should be possible to provide overdraft facilities in Jan Dhan accounts. It should be possible to provide 1,000, 2,000 rupees a month and you can pick and choose. You can maybe choose 5 crore, 10 crore accounts and screen them out. Sort of the 30 crore plus accounts that exist. You can identify which are the ones, and you can do exclusion criteria. See, now the data availability, and the primary thing has to be that this has to be an urban thing. That on the rural side we have employment guarantee, and which is demand based, thankfully. And if you can provide funding to the states, I think it should be possible to front load some of the spending. This has to be an urban thing. So once you do those screens with a reasonable level of accuracy, it should be possible to support incomes, given that plumbing channel exists.
Neelkanth, how does one start thinking about businesses? I mean, there are a lot of investors out there who are sort of grappling with the scale of this. Does one think of it, okay, let's say business exposed to the global markets, businesses exposed to dollar funding, then the next line becomes services businesses back home in India, and then consumption businesses, then financing to consumption businesses. How does that chain of impact on businesses start to play out?
Yeah, so when you are thinking about a stimulus, you have to, I think, take 3 seemingly disparate approaches which need to converge on something. So you may start with a benchmarking process as to what have other nations done. Of course, the impact on your economy could be very different from what it is in the US or China or Singapore or Hong Kong, or Italy or Germany. But that is an important benchmarking exercise, because I think that is how consensus building happens, because a lot of people will have to agree to that number. The rating agencies also, if everyone is doing 1% and you want to do 10%, that's also not possible. I'm not saying 10% is required, but so that calibration, that's the first approach. The second approach has to be how much is the loss of income, and that again at this stage will have to be somewhat broad-based. Are we losing 1% of GDP? Are we losing 2% of GDP? How much of it is permanent? How much of it is delayed? And then accordingly, using some design principles of what fiscal multiplier is going to be, come up with the size of the deficit, the size of the stimulus that is needed. The third has to be what you're saying, a bottom-up assessment of the sectors that are worst affected, and then try to provide some comfort. And it need not just be like GST rate cuts. I see some of the industry bodies petitioning the government. Everyone wants GST rate cuts. At this stage, rate cuts will not help. Right? There needs to be some consumption for the firms to benefit from it. It needs to be something which is in the direct income transfer range. So what may happen is that perhaps the best way to address some of the challenges may be just to transfer income into the hands of people. And on the banking and creditworthiness cash flow side, you try to find as many measures as possible. So while the 20,000 crores that Kerala announced yesterday, a lot of that is just, I think, the timing of the cash flow. So they have started to clear arrears. So basically, whatever was due from the government, instead of clear it very early, they brought forward pension payments. They're allowing people to delay electricity bill payments, not canceling them, but delaying them, and allowing 2,000 crores of loans to women self-help groups. So these are mechanisms that can be used to keep the system liquid, that where credit is needed, it kind of, and then once you've gone through this critical phase where there is a very sharp drop-off in earning capability, then you think about a sector-specific stimulus. But I think one of the factors that will have to come in is loan forbearance, especially for the MSMEs, and whatever has to happen, I think also the decisions now will be very different from the decisions 3 months later, hopefully by when the things on the disease side would have settled down. And when the sense of panic is a lot lower, I think it'll be much harder to take policy decisions on bailing out specific sectors. Because then the question will be somewhat similar to what's happening in telecom, that if these are private firms, is the government really responsible for bailing them out? So I would say that at this stage, it is important to look at the size and scale of the stimulus, and also, instead of just focusing on how much you can spend, try to keep things liquid, so that the problem that you highlighted, which I think is a very important one, that liquidity problems do not become solvency problems.
Neelkanth, that question was also equally from an investor standpoint. I think a lot of people are trying to judge the extent of impact on companies they are invested in, how long that will last, etc. Is there a way to start thinking about that now, or what are the benchmarks somebody can use?
Yeah, so it is important to start thinking about it now, but at this stage, I think that if I was thinking about the stock market, right? So moving from the economy to the stock market, the primary driver of the stock market so far in the last month or so has been foreign selling, right? And it's very clear that people are selling what they can, not what they should. On some sectors, there is differentiation. So consumer staples for a while was not falling as much. So of course, on bad days, it has also tanked as much. And you can see when all kinds of stocks are getting hammered. So that's a very important factor in the stock markets, that it is not yet a very differentiated approach to which is the company which is going to be better off at the end of it. I think that assessment will start now. In the first phase, it was all about that. And that uncertainty, those dollar shortages, which have driven some of this panic selling, where it seemed as if there was no price at which the selling would stop. And one hopes that phase is over, but I don't think one can be sure that phase is over. So when you're thinking of buying decisions, that's a very important factor to keep in mind. That we need to see clarity on what steps are going to be sufficient to control the spread of the virus, or to make it manageable, which is acceptable to society. So because now it's becoming clear that this virus may not go away, right? It will keep circling around till the time that we find a vaccine or a cure. And I think the fight right now is to minimize the number of deaths. Now, does that mean a 6-month clampdown? Does that mean a 3-month clampdown? Does that mean that the southern hemisphere, as it goes into its winter now, will have a serious growth in infections? And will we see a second wave 3-6 months later? So I think all of those uncertainties will be there. So that's the first level of uncertainty to get our hands around. Whenever that ends, the market bounces, because that uncertainty discount is there in the market right now, because no one knows at what level of economic damage this virus can be contained. The second is just the dollar liquidity, the funding markets, and it's hard to say which comes first. It could happen that the central banks are able to solve the liquidity problem much faster than we can address collectively the virus problem. But those are technical factors which also drive where the market stabilizes. Then we come to the question of what is the size of the economic damage. Right now, no one knows. Everyone is guessing. I think we'll keep guessing because I don't think anyone can ever forecast accurately. But getting the ballpark estimate of what is the size of the damage globally. Is it $4 trillion? Is it $2 trillion? In a global GDP of 85 trillion, if the global GDP growth doesn't, it falls from say 3% or 3.5% or whatever was expected to say 0%, that's like $2.5-3 trillion gone from incremental income. So once we know what the losses are, then we come to the question of who takes those losses. If, for example, because of a drop in income, there is a surge in retail loan defaults, which is one of the concerns that is emerging. Should the banks bear that? Should the borrowers who are over-leveraged take responsibility for that and have a permanently bad credit score? Not permanently, at least have a bad credit score till they somehow find a way of getting out of that. Or will it be better for all of us that there is regulatory forbearance and therefore kind of the taxpayer shares the cost in some ways on an indirect way? So you say that for 1 year, we're not going to recognize SME loans and retail defaults. So those decisions then will help us allocate these costs as to who's actually bearing these costs. And then will come the issue of how capable are governments in terms of forming a political consensus. There are elections due in the US. There is, of course, in Europe, whenever crisis happens. Of course, thankfully, the ECB is again saying whatever it takes and will protect the euro. But when the dust settles down, and I hope and I pray that it settles down quickly, given the nature of the humanitarian crisis, you will see some differences of opinion on how the fiscal issue has to be managed, because it is still not a fiscal union. And then how quickly can we come up with a solution and therefore go back to the level of output that we were used to till January. And so all of these things need to happen for the markets to go back to normal. And that's, I would say, quite some time away.
Okay. Two last questions, Neelkanth. So one is where you had actually started. So circling back to financial conditions in the local market starting to tighten again. You know, we've come off a very tough period for the financial sector. That gets exacerbated by this at a time when you don't even have the option to go overseas and borrow. That can be fairly debilitating. So that somehow has to be tackled. Maybe, you know, I hate to suggest it, but maybe it's the PSU banking network which has to be put into action, moral suasion to be used to ensure that credit somehow keeps flowing.
So I'm not sure moral suasion will work because it's also about because moral suasion, you know, is like asking people to be patriotic, and you know, there's a limited. I think I'm not questioning the patriotism of PSU bank employees, but I think, you know, if the risk for them is that they start getting investigated if there are bad loans and all that, and even if that's not happening, if there's a fear that they have, that okay, as of now everyone is panicking, but 6 months later when these loans go bad, then everyone will come after us. So it's a structural problem. I think what needs to happen is perhaps some credit guarantees being given, a fund being created. I mean, something like what the UK has done, where the Treasury or the government backstops to some extent the loan losses, and that allows banks to again go ahead and start lending. And this may be actually a great time to take some action on the reform side, given that there's no better time than this. I mean, basically create different decision structures and so on and so forth. So anyway, the point is that I totally agree. We need to get the credit dispersal schemes back up and running. Even before we get the organizations which are not lending to shape up, the ones that are capable of lending and the ones that are now again cautious because, and this is not because they're anti-national, this is because this is absolutely normal at this stage of the economic cycle to be afraid of loan defaults. So if you give them some comfort that, look, there is going to be a fiscal stimulus coming, we are going to revive, we are willing to spend, and see, everyone wants to make money. I mean, people start businesses to make money. And so if you give them comfort that, look, we are going to support demand, and in case you are still scared, if you're lending to small businesses, if you're giving last mile loans, we are willing to create this corpus of that can provide you credit guarantee. I think so. There are solutions in place that can be considered, and while the structure of this slowdown is very different, but demand slowdowns I think have been faced in the past as well, and there have been much worse financial systems which have coped with this. We should be able to cope with this, but I think decision making needs to be speeded up.
Okay. Last question then, Neelkanth. I know you're always reluctant to be prescriptive, but I still ask you for a few things that you think that need to be put in place relatively immediately, or a few red flags, particularly in financial markets, that need to be watched out for, and then those disorderly sort of functioning needs to be corrected quickly. What would those be?
Yeah, so I think the fact that bond mutual funds are staring at a liquidity problem is something that needs to be addressed. I think the fact that there is that the smaller private banks are currently more interested in survival than growth. There's no run on the banks, clearly. I mean, there doesn't seem to be any evidence of people running to withdraw deposits from the other banks. So that there's no such risk. But at this stage, the problem is of a lack of growth. And so how do we get, I think, and so those are the things to watch out for. I think the objective has to be to bring down the yields on corporate bonds in any which way, because in the secondary markets, some of those bonds already the yields have spiked up by 1.5% or so. In a sharply slowing economy, I think that is a sign of market dysfunction. So that needs to be addressed. And once some of those things are addressed, then we will be better prepared to solve the problem. But I must say that this is, I think, the monetary action and financial system can be just better prepared or made to function better, but the revival in growth may need very strong fiscal measures.
And just a word on the capital markets from the perspective of managing volatility. We've just had SEBI announce some measures to manage volatility. Some of that will need to continue as the situation evolves. Some countries have gone as far as banning short selling, etc. I don't know if you see or foresee a move towards that.
Hello.
Neelkanth, I'll just repeat that question. My last question was to you on the capital market regulator trying to manage volatility. There are some measures that have been announced today. Some countries have taken very strong steps like banning short selling, etc. Do you see that as an evolving situation as well?
Yeah, so I think, some market volatility is part of the market. You're in the market, you should be willing to withstand volatility. The demands to shut down markets or to ban short selling, and as if they will stabilize, because what they do is, I think there's been enough academic research on this. But if there is dysfunction starting to happen, and if it is because of some regulatory arbitrage that has emerged, and I think, so, and the good thing is that the regulators are on the ball. So they are tracking it and trying to address the problems as they find them, and which I think is the right way to go about it.
I'll leave it at that, Neelkanth. Thanks so much for your patience, and thanks for taking all of our questions in this very fast evolving situation. Thanks for watching Bloomberg Quint. Do go on to BloombergQuint.com. We'll have Neelkanth's comments up there as well soon.
According to a recent report, women today contribute nearly 75%